Welcome to the mid-quarter commentary review of Advanced Asset Management Advisors. I'm Bob Baker, President of AAMA, and joining me today is Phil Voelker, our Chief Investment Officer. Hey, Phil.
Hey, Bob.
How are you this morning?
Doing well.
Super. Before we get into the commentary, I thought I would do a brief introduction to AAMA. AAMA is an independent and fee-based investment advisory firm that was established back in 1999. We're located in Columbus, Ohio, and we place a high degree of emphasis on accessibility by the advisors that we work with the various portfolios. We also place a deep focus on market pricing and sector valuation. And we do this through our team of highly experienced investment professionals that have, on average, 30 plus years of experience managing assets. So let's just get right into things. We've seen stocks reach an all-time new high. Phil, can you give us a little fundamental perspective on whether those valuations are supported? Or are the markets getting ahead of themselves once again?
Well, it's interesting. The market had a fairly broad-based move in the first quarter and topped out in the last couple of days of the quarter, had a nice correction and has rallied back again to new highs. The problem is that it's still a concentrated move. And the top 10 stocks in the S&P now represent 35% of the market capitalization of the index. So they have a large influence on the performance of the cap-weighted index. But if you look down below the surface, 47% of the S&P 500 is above their 50-day moving average, 53 below. And if you look at the equal weighted S&P, it did hit a new high in late March, but has been lagging the S&P cap weighted for some time. And if you look at a broader index like the Russell 3000, which includes large, mid, and small, 4% of the stocks are making new lows and only 3% new high. Whereas back in December, just 4 months ago, 15% of stocks were making new highs. So within the market, the strength continues to narrow. And all that is occurring within a still overvalued market. You can pick any PE ratio you want, trailing, forward, cyclically adjusted. All the PE ratios are in the 90th percentile or higher. So the market continues to be overvalued, and the broad market has lagged the large cap leaders. So is the market ahead of itself? We would say probably a little bit at this point, especially if you look at the cap weighted indices.
Sure. Thanks for that perspective. Now, recently we reduced the equity exposure within our balanced portfolios. Phil, can you kind of give us a little detail on exactly what we were looking at when we did that?
Sure. In late March, we reduced the exposure in the balanced portfolio from 60% equities to 50%. And you may recall that the range of that equity exposure can range from 40 to 80. And it's been stuck at 60 for some time because interest rates have been repressed since the great financial crisis. So this is the first time we've had stocks in the overvalued range and coupled with competitive interest rates. And you can look at any place across the curve, overnight out to 30 years. Suddenly, interest rates are now competitive with stock yields and stock PEs. So, with a 5.4 T-bill, 5% earnings yield on stocks, and 1.5 to 2% dividend yield, the no volatility T-bills are suddenly comparatively attractive. So we're actually below our midpoint in equity allocation at 50 from the neutral 60.
Now let's take a moment and pivot and talk about another all-time high, and that is the U.S. national debt. What are your views on the debt situation, and is this something that all of us should be worried about, short-term and long-term?
Well, certainly it's something to be worried about. It's been discussed for 40 years as far as the trend of debt accumulation. And of course, it's accelerated now in the last 4 to 5 years. And like most people in Congress, they didn't really worry about it because interest rates were so low. The cost of carrying the debt was relatively benign. But now we have interest expense headed towards $1 trillion a year, which, to put it in perspective, our defense budget is about $850 billion. So interest expense has eclipsed the defense budget. It's not something that can go on forever. We enjoy still being the reserve currency of the world. So we can print as much as we want. The downside to that is that it creates more inflation. So certainly it's a concern. It's more of a concern today than it's ever been. Is it going to cause an immediate crisis? No, but it's a trend that needs to be looked at and paid attention to. And if nothing else, it may be best to look at duration of fixed income portfolios and potentially take that into consideration in using a shorter duration portfolio because of the rising debt.
Interesting. Now let's circle around and talk for a couple minutes about inflation and Fed policy. We began writing in our commentaries back in 2021 with the viewpoint that it'd be tougher to get rid of inflation than a lot of people thought. And that assessment seems to hold true today. Now, what's your recent view on the inflation reports and the latest Fed policy expectations?
Well, inflation reports fluctuate over time, but not nearly as fast as Fed policy or speculations about Fed policy. Headline inflation's come down a lot in the last year, but it's not back to where it should be. And we have to remember that a declining inflation rate simply means that prices are going up less fast, and the average consumer gets no relief from a slowing inflation rate. It just means the pain grows a little bit more slowly. But to put things into perspective, 1st of January, the markets were pricing in 6 rate cuts by the Fed. It's now down to maybe 1 or 2, and there's some speculation that the Fed may need to increase rates. In fact, the recent Fed minutes suggested there were some members of the committee holding that concept in mind. So if we look at the inflation reports since January, they've been disappointing. Inflation, looking at core PCE, is higher. The 6-month moving average has been moving up. It's not an environment that supports the Fed in cutting rates. So, it's in keeping with our general scenario that it's going to be tough for the Fed to get inflation back to 2%. If you look at the fiscal spending, the federal budget, and continuing to add to debt, continuing spending above trend line. There's no wonder that inflation is hard to corral. And our long-term scenario is that at some point the Fed may actually abandon their 2% target and let it run higher, 2.5%, 3%, so that they can keep their policy steady as opposed to making additional changes. We just think that it's going to be tough for them to hit their 2% target given today's fiscal position.
Sure. I think your point you made earlier is well taken, that, once something goes up 10% and the rate of ascent slows to 2%, you're still already paid the 10% in higher prices. So people still feel the pain of that in their pocketbook. And that's critical to a lot of people today. Higher interest rates have caused mortgage prices to go up, and from a year and a half, 2 years ago, it now costs almost double to triple the monthly payment to acquire a house. So it's a real interesting environment we're in right now. Anything else you'd like to add before we close the commentary?
No, I don't think so. The inflation reports, the contributors to inflation adjust over time. During the pandemic and for a year afterwards, we had car prices and durable goods prices moving up because of supply chain issues. And that's one of the reasons the Fed insisted that inflation was transitory. Well, it's now spread into labor costs, insurance costs, different pieces of inflation keep popping up at different times. So it's hard to see the overall inflation rate coming down to meet their target.
Sure. Well, thanks for taking the time, Phil, with me today to go through a lot of this data. As always, we'd like to thank anyone who is out there listening today or in the future to the commentary. If you'd like to contact us, you can contact us through our website or email us at engage@aamamail.com or call our main phone number. And we'd be happy to answer any questions you have about the markets or our portfolios. And as always, we think it's critical for you to get the information you need as quickly as possible. So please call us. Thanks, Phil.
Absolutely.